The Canadian banks are some of the most popular investment options for Canadians due to their stability and growth, and the sheer fact that they control the entire banking landscape in Canada. But there's more than one way to invest in these large, giant banks. You can either hold individual bank stocks directly, or you can hold a basket of bank stocks through an ETF. Because picking dividend stocks is just simply not for everyone, and by holding an ETF, you can simplify your investment decision-making process. And in Canada, you can hold one ETF that holds all the big banks and only the big banks in Canada. So that way you're getting exposure to RBC, TD, BMO, Bank of Nova Scotia, CIBC, and National Bank. And some of these ETFs are equally weighted. That means that the ETF will have the same portion of Scotiabank that has for TD, that has for RBC. Some ETFs are market cap weighted, meaning the bigger banks make up a bigger portion of that ETF. I'm going to walk you through the details as we go throughout this video. There's also ETFs that use covered call strategies, meaning you get more monthly income delivered to you every single month. And if you take a look at this chart, you'll notice that even amongst the big six banks, there is a difference of not only yield, but also market cap. For example, the largest bank out of the big six is Royal Bank with a market capitalization, meaning that bank is worth close to $180 billion. The smallest of the six is National Bank, and which is only worth $34 billion. And if you take a look at the dividend yield, you'll notice that National Bank has the lowest dividend yield at just over 4%. And on the other hand, Scotiabank has the largest yield, getting close to that 7% mark. Now, when you're taking a look at this list, you might be thinking, is it better to invest in RBC? Is it better to invest in BMO? Do you go for the higher yield? Do you go for the lower yield? Do you mix and match? How much do you put in TD? How much do you put in BMO? And that's where ETFs kick in. They make that investment decision for you. So you will hold one ETF, it will allocate your money amongst the big six, and you don't have to do anything. All you do is sit back and you collect your monthly distribution every single month consistently. And the other bonus is that these banks, they pay quarterly. So you'll have to wait 3 months to get your dividend. But by holding an ETF that holds these banks, you actually get a monthly distribution, if that's something that you're looking for. Let's dive right into these ETFs and see what they're all about. The first one we're going to talk about today is ZEB, which is the BMO Equal Weight Banks Index ETF. Meaning this ETF will hold all 6 big banks in equal proportion, and you'll see that a little bit later in this video. Let's go through the overview. The ticker symbol is ZEB. It's trading for around $32 per unit, and it has assets under management of just under $4.5 billion. So as you can see, this is a very popular ETF. It has a market trading volume of close to 2.7 million. Again, all indicators, especially if this is a big number, this is another big number, you'll see this is a very popular ETF if you're looking for that popularity. And it pays an annualized distribution yield of 5.12%, and the MER ratio is 0.28%. So this is how you judge popularity, and this is how you judge how expensive an ETF is. The lower, the better. The risk rating for this ETF is medium, and the strategy for this particular ETF is that it has been designed to replicate to the extent possible performance of the selected equal weight Canada Banks Index, which just essentially means that the ETF holds the banks in equal proportion. And who is this ETF designed for? Well, if you're looking for growth solutions, if you're looking for exposure to just the big 6 banks in Canada, and it's equally weighted to lessen security-specific risk, meaning RBC will have the same weighting as National Bank, even though RBC is much bigger, but it will give you an equal allocation to RBC and National Bank as an example. And if we take a look at the growth, since this fund has been launched since 2009, if you had invested $10,000 since then, your fund or your investment of that $10,000 would be worth over $36,000 in that time span. Well, what does that really mean? Well, that means that your annualized return since inception is over 10%. That's a pretty good rate of return every single year, which if you look at another way, if you had invested $10,000, you have made close to 300% on your initial investment since this ETF was launched back in 2009. Your money has pretty much tripled in that time span. That means you would have done really well just by investing in the big 6 banks. Now, obviously, past performance does not indicate our future results, meaning that even though that this performance is 10% annually, you may not get 10% tomorrow, the next year, and the next 5 years. It's just a reflection of how it's performed in the past. And we've already taken a look at some of these fund details earlier. The main call is that if you are investing in this ETF, you can put into your RRSP, your RIF, your RESP, your DPSP, your TFSA, and even the newly launched First Home Savings Account. They can technically invest in the big six banks, get a mortgage from the big six banks to invest in your first home. It's all connected. And if we take a look at the distribution history, you'll notice that it's been paying 14 cents every single month since the start of this year. So unlike investing in individual bank stocks where you have to wait each quarter to get your dividend income, you get paid every single month. And as you can see, you get paid roughly at the start of each month. And if I were to go back to 2016, you'll notice that the fund was paying roughly 7 cents per unit in 2016 every single month. And now from 2016 to 2023, it has close to doubled on what your distribution is. That's another benefit of holding onto an ETF like this. Not only do you get to see capital appreciation, meaning if the fund was trading at whatever it was when it first launched, now it's trading at a higher share value, but you're also getting paid more to just collect your dividends. And if I were to take a look at the holdings breakdown, there should be no surprise. All you'll see is the big banks: National, TD, Bank of Nova Scotia, CIBC, BMO, Royal Bank. And you'll see that National has a 17% rating in here, or allocation, and RBC has 16%. So it's fairly equal between 16 to 17%. You get an equal proportion of each of these big banks. The one thing I do want to call out is that if you're really interested in learning about this ETF, or any ETF for that matter, definitely want to take a look at the ETF facts, the fact sheet, because it can give you some really cool information that you can get just from their website. So I would recommend, if you're investing in any ETF, do your due diligence, go through the ETF facts. There's a lot of cool information here. And same thing with the fact sheet. Again, you get some really cool detailed information just by going through these two documents. And I 100% recommend going through these documents and as much information as possible before you start investing. The next ETF I want to talk about is called ZWB, which is a BMO Covered Call Canadian Banks ETF. The only major difference between ZEB and ZWB is that it uses a covered call option strategy to augment your monthly dividend income. And I'll show you what I mean in a quick second. Let's take a look at the overview. The ticker symbol is ZWB. It has a closing market price, meaning it's trading for roughly $17 a unit. It has net assets of close to $3 billion. And the market volume is about 500,000, meaning about 500,000 units of ZWB are traded, bought and sold at any given point in a day. Still notice that here is where the main difference is between ZEB and ZWB. The distribution yield is 7.65%, or roughly 2.5% more than ZEB. And here's the other piece. The annual management fee and the expense ratio is much higher, 28 basis points versus 71 basis points. It is more than twice as expensive as ZEB, just for the benefit of using a covered call strategy. Distributions are monthly, and it's also rated medium in terms of its risk rating. Now, if you take a look at the fund benefits, there are some differences. This is also designed for investors looking for higher income. It's invested in a diversified portfolio of Canadian banks. Again, no surprise. Here's another big call out. This uses a call option strategy to reduce volatility. So why are you actually getting a higher yield compared to ZEB? Well, this ETF has been designed to provide a portfolio exposure to the big banks, we know that, while earning call options premium. So this piece right here, this is what's helping generate that extra 2.5% in annual yield. The fund is investing in the big banks, and it dynamically writes these covered call options to help generate that higher yield. And these call options are written out of the money and selected based on analyzing the options implied volatility. Now, this is where there's some complexity in an ETF, but as a passive investor, you don't really have to worry too much about this if your whole goal is to just get a higher yield and get paid more every single month. If you had invested $10,000 back in January of 2011 when the fund first launched, that will be worth close to $25,000 today. That's a pretty good return based on your $10,000 initial investment. Well, what's interesting is that this fund has performed 8% since inception. And remember, ZEB, although it launched 2 years earlier, it had generated close to a 10% annual return, meaning you are paying more for the luxury of getting that higher monthly income, but your total return, because again, total return is capital appreciation plus dividends. You get more dividends, less capital appreciation, so your total return shrinks. So if you are focused on total return from the big banks, ZEB actually makes more sense. But if you don't really care about total return as much, you just want that higher monthly income, then maybe ZWB is an option for you to consider. And the only other call out here is that it's eligible for your RRSP, your RIS, RESP, DPSP, TFSA, or the newly launched First Home Savings Account. Here's another piece that I really want to go over. Notice how it was paying 12 cents ZWB at the start of the year, January. That 12 cents is now dropped to 11 cents. So here's where you see the little bit of volatility because it's using covered calls. If those covered calls are not going well, you may actually see a distribution cut. Whereas if we saw ZEB, it paid 14 cents consistently. So you do have a little bit of higher risk because you're going for that higher income stream. So if I go back to 2013, it was paying roughly 7 cents per unit. And that 7 cents is now, well, it was 12 cents until they recently dropped to 11 cents. So this is something for you to consider. If you're worried that your dividend may get cut because if the covered calls are not doing it so well, then maybe you're just better off without the covered call strategy and just going with the straight ZEB, get your banks, no fancy covered calls needed. Now, if you're paying it close attention, notice that the number of holdings here is 41 compared to ZEB where it had 7 holdings. The reason for the higher number of holdings is not because there's 41 banks. As you'll see, the banks are similar. It actually holds 23% of ZEB. So you're actually getting exposure to ZEB through this ETF. And it adds on National, TD, Bank of Nova Scotia, roughly the same allocation, 12 to 13%. Right here, this is why it has more holdings because of the covered calls on each of the banks. I highly recommend looking at the ETF facts, the fact sheets, how it actually uses covered calls. This will give you more insights as to how the ETF works because no one will care more about your money than you will. So you have to do yourself a favor, do your due diligence, read the documentation, do your research before you invest. So if there is a dividend cut, if there is a change down the road, you know what you're in for before you start investing your own dollars. Because as I always say on this channel, you work hard for your money and you want your money not to work just as hard, but you want your money to work harder than you do. The next ETF I want to talk about is RBNK or RBank, the RBC Canadian Bank Yield Index ETF. This is slightly different than ZEB. It's also different than ZWB, and I'll talk about those differences. RBC Canadian Bank Yield Index ETF seeks to replicate to the extent possible, before fees, the performance of a portfolio of Canadian bank stocks. No surprise, it's another bank-focused ETF. And the reason you want to consider RBNK versus the other two potentially is that it has a unique approach, meaning the unique stock weighting methodology is designed to provide enhanced dividend yield and your return potential. It's a simple and efficient way to invest in the Canadian banks, and it's an attractive source of tax-efficient income because dividends are more tax-efficient than regular income. If you know anything about Canadian banks, they have a very steady history of dividend growth. And before you invest in this ETF, here are the ETF facts, a monthly update. So definitely consider these two documents before you invest in this ETF. What's interesting about this is that you'll notice that this fund launched back in 2017 of October, roughly around $20 a share. It hasn't grown all that much. It had a run up until 2022. Then markets went down, and now it's still trading roughly around the same price. So it's been relatively flat over that time period. And the risk rating, it's considered medium to high. The MER ratio is 32 basis points. It has net assets under management of $237 million. So you'll notice that the MER is higher than ZEB. It's less popular than ZEB because it only has less than $250 million of assets under management. And ZEB, as reference, had close to $4.4 billion of assets under management. So definitely less popular. And income is paid monthly. And the reason I'm making all these callouts is that when you are investing in ETFs, it doesn't have to be bank ETFs, any ETFs, these are some of the factors you want to consider. What are the assets under management? What is the MER ratio? Does it pay monthly, quarterly, annually? How has the past performance been? Is it seen growth in the past? You want to go through the documentation, do your due diligence, see that all the things that I personally do before I invest a single dollar into any ETF. So if we take a look at the portfolio analysis, it has six stocks in the ETF. No surprise, there's 6 big banks in Canada. The yield on this is close to 5.6%, so it offers a higher yield than ZEB. If I were to take a look at the monthly distributions, it started off paying 9.5 shares at the start of the year in 2023. It has fairly recently increased at 9.5 cents per distribution to 10 cents. It's definitely offering that income growth potential if you're looking for income growth. And if I were to go back to 2018, you'll see that income has definitely grown. It was paying roughly 6 cents, 5.8 cents through 2020. Since 2018, and that has grown 9.5 or actually 10 cents today. And what is that portfolio strategy that's so different than ZEB and ZWB. So if you take a look at this ETF, it actually holds a larger portion of Bank of Nova Scotia, 25%, and a lower portion of RBC at 8.4%. So the reason for this is that it invests a higher portion in the bank that has a higher yield. So if you remember earlier in the video, I showed you that Bank of Nova Scotia has the highest yield out of the big six banks, whereas National Bank and RBC had the lower yield. So the strategy here is to invest more in the banks that have a higher yield and invest relatively less in the banks that have a lower yield. And the reason is to give the ETF a higher yield than compared to an equal weighted ETF. So that's why this bank can offer a yield of 5.6% compared to the 5.12% that we saw through with ZEB. Moving right along to the next ETF, this one is called HEWB and has a yield of 5.09%, and the name is the Hamilton Canadian Bank Equal Weight Index ETF. And Hamilton ETFs, they've been making a big splash in the market recently by offering some ETFs that have crazy high yields of 13%, of 14%. And if you're interested in what those ETFs look like, I will leave a link in the description for some of the highest yielding ETFs available in the country in the description below. So check that out if you're definitely interested. Now, the biggest differentiator between this ETF, since it's also equally weighted, is that it offers, or supposedly offers, a lower cost option alternative than compared to ZEB. Let's dig through some of the details. It's one of the lowest cost Canadian bank ETFs, has a monthly distribution, which is good if you're looking for monthly dividend income, and has a yield of just over 5%, and it invests in the big six banks equally. Dividends from Canadian banks are actually more tax efficient than your monthly salary, or if you have rental property, Canadian dividends are actually more tax efficient than your other source of income. It's a good fit for investors who are looking for monthly income, tax efficient distribution, and a low fee exposure to the big six banks. And similar to other indexes, it's also tracking the selective Equal Weight Canada Banks Index. And here is the HEWB fact sheet. So again, if you are interested in investing in this ETF, you definitely want to go through this document. It's roughly trading at $15 a unit and has a yield of 5%, as we've already talked about. And here they've put this in big, bold, giant letters that this offers a management fee of 0.19%. And as a comparative, ZEB, which uses a similar strategy, equal weighted approach, at an end management expense ratio of 25 basis points. Compare that to 19. You're saving roughly about 6 basis points, so it's definitely cheaper than ZEB. So what they're highlighting is that if you're looking to beat the TSX 60 index, in theory, since March of 2007, the big six banks have actually outperformed the TSX. Again, past performance is not an indicator of future results. You don't know if the big six banks will continue to outperform the TSX, but it gives you some historical context. So if we take a look at the holdings, TD Bank has a rating around 17.2% and RBC with 16%, so it's definitely equally weighted between 16 to 17%. And this is a relative newcomer to the market. It's only been around since April of 2023 compared to the other ETFs we've looked at so far that have been around for a good 5-10 years. It has over $500,000 of assets under management. This is another very popular ETF because it's amassed $500 million worth of investments since April, and it's only been a few months since launch. Distributions are monthly. It's balanced every 6 months or so. And if you see the weightings at 16 to 17, so meaning every 6 months, it'll make sure that they have an equal weighting. But then as the markets go up and down throughout those 6 months, the weights will shift. They will reset the weights to make sure that they're even every 6 months. There's not much history to go back on. It's only been around for a few months, but you'll notice that it's been paying a 6.9 cent distribution every single month since launch. And here's another area where I really want you to focus on. If you are interested in this ETF, it is the documents. Read the press releases, go through the fact sheet, go through the ETF facts, the prospectus if you're interested. The next ETF I want to talk about is called HEWB, or the Horizons Equal Weight Canada Banks Index ETF. So it's using a similar strategy compared to ZEB and compared to HEB, using the equal weight approach. It's offered by Horizons ETFs. It also follows the selective Equal Weight Canada Banks Index. No surprise here, it is taking an equal weighted approach to invest in the big six banks. It's traded for roughly $28 per unit and has a daily trading volume of 11,000. though not as popular as we saw with ZEB, which had a trading volume of 2.7 million compared to only 11,000. So it's not as popular as ZEB, but has a similar risk rating at medium. Let's look at some of the other fund details. It's been around since 2019, so it's been around for a few years, and only has net assets under management of less than 115 million. It's probably the least popular of the ETFs we've shown so far. In terms of its management expense ratio, it's coming in at 0.27%. So it's slightly less expensive than ZEB at 0.28%, and definitely more expensive than HEB versus 19 basis points. We'll take a look at its performance since inception. If you had invested since it launched for $20 back in 2019 in January, that $20 would be worth roughly around $29 in August of 2023. You've seen $8 worth of capital appreciation since 2019. So meaning, if we take a look at its annual rate of return, it offers a return of 9.37%. Now, one thing I want to point out here is that, well, how is it all that different than ZEB? It's less popular. It's more expensive than HEB. So what's the point of even looking at HEWB? It seems like it's not even worth considering. Here's what I want to talk about. It actually offers no distributions. And now you're thinking, well, now I have even one less reason. So it's less popular than ZEB, has no distributions, it's more expensive than HEB. So why on earth would you even want to consider HEWB? And the reason is, and I've already mentioned this, that Canadian banks or investing in Canadian stocks is more tax efficient than, let's say, your salary income, your rental income, or other source of income. So you're more tax efficient with Canadian eligible dividends. Well, this takes one step further. By offering no distributions, you really have to pay no tax because there's no income for you to pay tax on. So instead, when you sell your shares of HEWB, you're going to pay tax at that point. So what it does, it gives you control of when you pay tax. Because if you don't sell any shares, you're not really paying any taxes. You may decide to sell your shares of HEWB maybe 5 years down the road. So you will pay tax on that capital appreciation 5 years later. And you're not paying tax every single year because there's no monthly income, there's no annual income for you to pay tax on. So that's the major reason you would consider something like HEWB if you're looking for investment options in the big six banks, but you don't want any single distribution. You don't want monthly income at all. You just want pure capital appreciation. And if we take a look at the investing strategy, no surprise here, it's equally weighted, so 17% for TD and 16% for RBC. And I've just given you a quick snapshot of why this doesn't offer any distributions, but definitely go through the product sheet, some educational PDF documents here, so you can learn more why HEB is an option compared to the other ETFs I've talked about. And the last one I want to talk about is HBA, the Hamilton Australian Bank Equal Weighted Index. I thought this was a video about Canadian banks. So as I've talked about so far, all the 5 ETFs I've covered in this video, they all invest in the big 6 banks in Canada. But this one, I just want to throw this out there as well, plus one. You can actually invest in the Australian banks through the same approach that you would get with ZEB or HEB, meaning that equal weighted approach, but you're getting dividends or exposure to a completely different oligopoly. You're getting exposure to the Australian bank oligopoly, which is very similar to Canada. They also dominate the market over there. So it gives you some more of that geographical exposure that you will get through the big 6 banks. So that's why HBA has a tagline of dividends from down under. Let's go through some of the details. This has been one of the top performing financial ETFs in Canada in the last 2 years, and it has performed 17% annualized since inception. Keep in mind, HBA hasn't been around for all that long, so this 17% may look rosier than reality. What's interesting is that it actually generates a higher yield than compared to ZEB or HEB, so you're getting 5.7% compared to the low 5% that you get with ZEB or HEB. But keep in mind, this has quarterly distributions, not monthly. And according to Hamilton ETFs, historically, Australian banks have had similar returns / volatility compared to Canadian banks over the last 10-20 years. Who is this ETF really a good fit for? Well, if you want equal weight to Australia's big 5, so how you have the big 6 here, Australia has a big 5 banking oligopoly. Australia also has, very similar to Canada, Australia has a very dominant scene when it comes to the banking space. You also get attractive quarterly dividends and growth potential. The other major benefit that you get from this ETF that you don't really get with In the 5 minutes, for obvious reasons, diversification, Australian banks have a relatively low correlation to Canadian banks, and how the other ETFs were focused on the selective Canadian banks index, while this one is focused on the selective Australian bank equal weight index. In this one, you get big 5 from Australia, and the other ones I've talked about, you get the big 6 in Canada. Let's go through some more details. Has a high yield of 5.7%, and since its inception, it's done 17.74%. It's performed 18% in the last 3 years. So just as a quick comparative, if we take a look at the last 3 years, HBA has performed at 18.58%. And if we take a look at the ZEB as a comparative, it has performed 17.71%. So technically, you got slightly more outperformance at 18.58% from the Australian banks than compared to the Canadian banks at 17. Not a huge earth-shattering difference, maybe 1% more, but it gives you some context. In the last 1 year, it's performed at 7.46%. Meanwhile, in the last year, ZEB has performed 3.5%. So HBA has beaten ZEB, or the big 6 banks in Canada, just for the last 1 year so far. So if you had invested $10,000 when this fund launched back in June of 2020, that $10,000 with all those dividends along the way, you'd be looking at a cool $16,000, almost $17,000 today. As you can see, the big 5 Australian banks had a major run-up from June of 2020 to roughly about Jan of 2022, where it got most of that gains, and it's been relatively flat since then. And here are the big 5 Aussie banks: ANZ Group Holdings, Commonwealth Bank of Australia, Westpac Banking Corp, National Australia Bank, Macquarie Group, and ANZ has 21%, so roughly equally weighted. Because the markets will move every single day, the fund only rebalances at certain points in time. So when this weighting is out of whack, it will rebalance to make sure that they are roughly 20% when it does its rebalance. The real cool benefit is that you get exposure to the Australian banks, and this ETF is listed on TSX, so you can invest in Canadian dollars and not have to worry about any foreign conversion. And you can invest in your RRSP, RIF, DPSP, RDSP, First Home Savings Account, RESP, whatever you want. So you can add exposure to the Australian banks into multiple different tax-sheltered accounts in Canada. Assets under management are roughly $125 million. Not super popular because most likely people don't know that this ETF exists, but that's how I want to throw this in this video, is that it gives you an alternative, something for you to consider. The distributions are quarterly, and it balances every 6 months. The one other call is that it is slightly more expensive than ZEB or Canadian banks at 55 basis points. It's almost twice as expensive as ZEB or HEB. And if you take a look at the distributions, it's paid 31 cents per quarter for the last few quarters, and also paid a special cash distribution of 60 cents January of 2023. You'll notice that there are instances where it's paying an extra cash dividend, where it paid one in July of 30 cents, and then it paid an extra 20 cents as a special cash distribution, and then the quarterlies continue. Don't just take my word for it. Definitely do your due diligence. Go through the fact sheet, the ETF facts, the prospective, financial statements. Do your due diligence before investing in this ETF or any ETF for that matter. So that was a lot of information on these 6 ETFs that focus on the banking landscape, 5 of them being Canada and 1 Australian just for funsies. So what I want to do is just summarize all this in a cool little spreadsheet. So what I want to do here is just summarize all the information we talked about, a quick snapshot of the 6 ETFs I talked about. So here are your 6 ETFs and how much you're trading for. So for example, you'd pay $32 to buy a ZEB, and you're paying $15 to buy HEB. And here is a yield summary. Keep in mind, HEWB does not have a yield because it doesn't pay out a distribution. So the highest yielding ETF should be no surprise. It is the Canadian Banks ETF that offers a covered call strategy, and that is ZWB. You're looking at close to a 7.75% yield. The lowest yielding option is ZEB, or the non-covered call flavor. It just follows the big 6 banks, equally weighted, relatively simple. You're getting your 5% yield. And the other 3 ETFs sort of fall in between. The Australian one has a higher yield than compared to ZEB and compared to RBNK and compared to HEB, close to 6%. And what I'm highlighting here is that let's say you're looking for $1,000 a month in passive income, or $2,000 a month, or $3,000 a month in passive income. How much do you have to invest in these ETFs for to get that $3,000? Let's say you want to generate $1,000 a month and you want to invest in ZWB. Well, you have to put down $155,000 of your capital to get $1,000 a month from ZWB. And if you want to invest in RBNK with a special focus on going for the highest yielding banks and using that approach to weight its allocation, for $1,000 a month, you'd have to invest $228,000. If you want $3,000 a month, you have to invest $465,000 of your money into ZWB. And this shows you the same concept in just a different way. So let's say you have $5,000. Well, you have your options here. If you have $5,000, that gets you 293 shares of ZWB, which is monthly income of $32. If you invest $5,000 in HEB, it'll get you more shares than ZWB, but slightly lower income because it offers a lower yield, but HEB is trading for less than ZWB. So HEB is going for $15 a pop, it's going for $17 a pop, so that's why there's a difference. What if you had $10,000 or let's do $30,000? All right, now we're seeing that monthly income go up. So if you have $30,000 to invest, you're getting roughly 1,760 shares for ZWB and close to $200 in monthly income. And I'll leave a link to this file in the description of this video so you can play around with the numbers, you can play around with the investment options. So now that we've seen some of the different options available for investing in the big 6 banks or that one extra option investing in the 5 big Australian banks, you'd be thinking, well, are you better off investing in the big 6 banks in Canada individually? Are you better off buying that 1 share of RBC, that 1 share of National, where you get 3 shares of TD? Or are you better off just buy that ETF? Well, there is some merit into holding an ETF. Well, yes, there's only 6 stocks out there, so it's not that hard to just pick up individual shares of whatever bank you're interested in. But if you're not interested in portfolio rebalancing, you don't want to think about, well, how much of RBC do I want to buy? How much of National am I buying? 1 share of RBC, 3 shares of National. Maybe I want to play around with that exposure. You want to be completely hands off. And the beauty is that for $15, as we saw with HEB, you can get 1 share of HEB and you get exposure to all 6 banks equally because you're holding that 1 share of HEB. So if you have relatively small amounts of capital, maybe the ETF makes more sense rather than buying tiny fractions or, 1 RBC, which will cost you more than $100. But having said all that, if you are using Wealthsimple, you can actually buy fractional shares. So you don't have to buy that 1 share of RBC. You can buy 1/10 of an RBC share, 1/10 of a TD share, whatever fractional piece you want. So maybe, because the point of the ETFs was that you get exposure to the banks, and if you have relatively small dollars you want to invest, like $15, $30, or whatever you want to do, you can get all 6 of them. But with fractional investing, you can actually buy your own fractional shares of whatever bank you're interested in. But again, you have to be active on that front. If you just want to be passive, completely hands off, then maybe you are better going for those ETFs that focus on just the banks. However, if you want to play around with fractional investing or learn more about whatever fractional investing means, I will leave a link to Wealthsimple in the description of this video so you can check that out for yourself. The other benefit you want to consider is that if you want monthly income from the big 6 banks, you're not going to get that by investing in the banks yourself because they pay quarterly. So if you want monthly income, hands off, pure passive, the ETF makes more sense. Thank you so much for watching. That's what I wanted to cover. Hopefully you found this video informative. You've now seen that if you want to invest in the bank ETFs, are you better off holding ETFs or are you better off buying individual stocks yourselves? Again, it comes down to passive versus hands-off. Hands-off, maybe you want to buy that bank ETF. Hands-on, maybe you want to buy those Canadian banks directly. And as a fun alternative, I even threw in that Australian banks ETFs if you want exposure to an oligopoly of banks in a different geography. You can get HB as an example. I will leave a link to the file that I showed you in this video that summarizes all those full facts and helps you play around with calculations of how much to invest in each ETF in the description below. I also have other offers for you to check out in the description below, so definitely do check out those offers. It's a big support of the channel and for me to keep creating this content. Last but not least, please hit that like, subscribe, and thanks button if you enjoyed this video. Definitely appreciate that. That's all for now, and I'll talk to you in the comment section.